Welcome to Host Now Live. We are so glad that you're here to join us in today's conversation titled Investing in Uncertain Times. So my name is Maya and I'll be your host for today's session. Host Now Live is a platform for us to invite guest speakers, industry experts, and specialists to come on board and answer questions that you have posted or you are curious about. So right now, there are some of our audiences on our Facebook, LinkedIn, YouTube channels, and of course, those that are on our official website. So here's the link below to our official website. If you have any questions during the session or now, please feel free to write in, and then we can look through your questions and we can ask our industry experts. So today, all right, we have with us very, very special two guest speakers. All right, so there will we want to introduce. So today we have Chris and Jonathan with us. Say hi, Chris and Jonathan.
Hello.
So let me properly introduce. Chris is a property investment consultant from PropNext. Coming from a real estate background from National University of Singapore, he is very well versed in property analysis through research, numbers, and figures. Currently, his focus is in CBD areas such as Marina Bay, Raffles Place, downtown, and Bugis area. He believes asset progression planning, which involves in-depth structuring of portfolio of individuals to generate highest interest return based on clients' comfort level. So over the years, Chris has achieved spectacular results in his career, achieving titles such as Super Platinum Achiever and Top Individual Producer, and many, many more. So he was coined as the youngest Super Platinum Achiever in PropNext and made it to the Top 5 Achiever Award for last year, 2019. He is currently ranked as a top 12 producer in PropNext in 2020. He was also interviewed live by the CEO PropNext, which was featured on official PropNext Facebook page. And at the age of 24, Chris actually invested in his undervalued CBD property at Marina Bay and had paper gain of 180K in his portfolio already. So Chris' mission is to crystallize Singaporeans' property investment dreams. He believes that through careful planning and structuring, properties investments can be made affordable to the masses at a very low risk. So Chris, would you like to do a short introduction about yourself, please?
So hi everyone, my name is Chris. I focus on property investment. And thank you Maya and Iwan for hosting this event. And thank you everyone for coming for today's seminar. So for myself, I always believe that real estate is not simply about speculations, but it's made on numbers and figures. And through fundamental and technical analysis, I help my clients make almost 200, 300K in less than just 1 year and be able to make a rental profit of almost 20-30% of the market rate. So for myself,
so now we will have our second speaker, which is Jonathan Yeo, who is also a wealth manager. He coaches his client as they take baby steps into the world of investing towards their measurable goals. So if let's say you have no idea what to do, you have a sum of money that you want to invest in shares in the market, he is the person you have to go to. So new investors are introduced to shares investing in a systematic way to differentiate the good, the bad, and the ugly. So in 2018, Jonathan actually helps his clients to achieve a 320K in dividends, to earn a 320K thousand of dividends, worth of dividends from a base of 5.8 million. So Jonathan, could you please share with us more about yourself, please?
Hi everyone. When I first started investing, I based all my decisions into the stock market on rumors. People would tell me about why this company called Renong in Malaysia was a sure bet. So guess what? Those so-called sure bets turned out to be false. I was stuck in Malaysian club shares for nearly 5 years. Since then, I've learned, just like Chris has, that there is a science to investing, that there are things called valuations, undervalued, overvalued, and then you can also use technical factors to come and bring the right time into the market. So this is where I am today, from the time where I started when it was rumor driven to today, where we use the science of investing, where there is a methodical way to invest correctly. Back to you, Maya.
All right, thank you both for your introduction. So what we're going to do is that we're going to take a few questions and ask our experts, industry experts. And then meanwhile, if you have any questions along the way, please feel free to go down to the website below. There is a Q&A session where you can just ask any questions that you have in mind at any point of time. All right, so if you are on our Facebook, on our YouTube, hello. So feel free to come over to our official website so you can type in your question and send it over to us. All right. So for a very start, we would like to ask Chris this very broad question about like this current market right now, the COVID situation, right? There's so many people like wondering like, what should we do? Will the property market crash during this period? And then how's the economical situation? So Chris, could you share with us more?
And thank you, Maya. So this is quite a common question asked to a lot of clients. And for them, what I'll do is I'll show them a basic analysis, which you can see in the data below. So for myself, right, as I mentioned just now, technical and fundamental analysis is very important for property. So when people ask me, is Singapore property going to crash during situation for COVID-19? I'll first look at the property bubble situation in Singapore. And currently, as you can see in this graph below, the property bubble in Singapore is almost one of the lowest in the whole entire Southeast Asian and also entire world, at almost 0.45 as compared to Hong Kong or Toronto that's going at 1.8 to almost 2 in the areas. So for myself, what I look at is a very key technical indicator. The first thing I look at is in terms of the gross domestic product, which is GDP versus that of the residential property index, which tracks the current progress in the property market. So you can see in this graph below, the red line signifies that of the GDP, and the blue line signifies that of the residential property index, which tracks the property growth. So whenever you see the blue line exceeding that of the red line, there is a bubble. That's why there's a bubble T here. And same, when there is in 1996, the Asian financial crisis, when people buy overvalued properties and the property market went all the way up and crashed as a bubble. This was the second bubble, and then there was a dot-com crash, and thereafter a Lehman Brothers crash. And in 2009 all the way to 2013, you can see that the current residential property index is going in tandem with that of the gross domestic product, the GDP. And 2013, what the government did was that it included this thing called the cooling measures, which caused it to fall in prices way below that of the GDP. So while our GDP is rising, what we see in the current property market is that the property is way below that of GDP and is rather considered undervalued. And that is why Singapore property bubble, when there is no bubble in the first place, it's hard for it to burst. And this, in fact, if you understand even clearer, is considerably a good entry point, because you can see even another indicator to look at in terms of fundamental analysis is in terms of the mortgage payment versus the income. Long time back, you can see in 1996, most of the individuals are borrowing 78% of income to buy property. But today, it fall all the way to 29%, which is very safe. And that itself shows that the likelihood for people to default their mortgage is much less, especially in 2013, when the government came out with this thing called the TDSR, which helps to limit the amount of loan that we have. So the current question is, will the market crash? So the market will only crash when there is a bubble, which is driven by speculation, number one. Number two, the bubble will only burst when people default their mortgage. So you consider in 2013 when TDSR is out, what you will see is that there's a limit where people can borrow. And ever since the three financial crises that happened throughout this period of time, you can see that most of the people who have defaulted their mortgage, who cannot afford to borrow enough loans to buy a property, has already withered out in this cycle. And together with TDSR, it form a very strong fundamental that allow us to not be able to have this same situation again, where individuals default loans and end up selling their prices at a fire sale, which will then lead to a drop in the property market if that happens. So without this bubble bursting, what you can see is that Singapore property market, even during times of economic crisis, even in times of COVID-19, can be projected to remain resilient during this period of time. And the last thing I want to highlight is in terms of 2018, if you remember, there was a cooling measure that happened, the AVSP. And even that cooling measure in 2018, the green circle in the graph below, the property market only dropped by a bit, maybe less than 1 to 2%, and went up again. This shows that Singapore property market has a very strong confidence, and during even in COVID-19 situation and economic crisis, it has strong fundamentals that allow it to not crash and continue to at least plateau for a period of while before going up when the whole crisis is over. And the last final thing is that current Singapore property, in terms of fundamentals wise, we have 423 billion worth of cash in Singapore population. Meanwhile, for loan wise, it's 326 billion. So it shows that our cash versus liability has a very, very strong margin in the sense that we have more cash than debt. And this shows that a lot of Singaporeans actually have the cash to hold and is waiting for the market. And currently, in terms of the sentiments, they may not be good, but they have the purchasing power to pump the property. So once you can see after this whole situation is over, you can project a very huge rise in that of the property market instead of a crash in a bubble during this period. So that's from me. Maya, back to you.
All right. So we are currently so convinced that the market won't crash. Is it time to buy some property? So meanwhile, so let's talk about like the shares market, right? So now that the prices is falling because of this COVID situation, Jonathan, could you just share with us like, should we actually invest during this period? Should we spend money during this period, especially when the prices is crashing down? Could you just share with us more?
The share market is a place where investors like you and I take part as partners of companies that can grow, that products and services are demand and wanted. Now, all of us are staying at home during this circuit breaker season. So what do? Well, some of us cook a lot more. Some of us go shopping. We cut our travel. We cut our staycations, vacations. So you can see that there are some winners and some losers. Overall, perhaps the demand in the economy has come down, but there are certain sectors that are doing well. Do you still shop at Cold Storage, Sheng Siong, NTUC FairPrice? Have you stopped buying your toothpaste, your shampoos, your body wash? Well, there are brands behind these companies. They are Procter & Gamble. They are Johnson & Johnson. They are Sheng Siong. And of course, we watch a lot of Netflix. And guess what? Some of us are not just on Zoom. Some of us are also on Microsoft Teams. So there are some winners and of course a lot more losers. So during this time, it is a stock picker's dream because you can pick sectors and don't simply put your money invested into a unit trust or a fund that buys the whole market. You have to be selective because this is the best season to be selective. So back to you, Maya.
All right. So now that we know like what is going on in this market, I believe that this is a period where we should actually put in more money, I suppose, and then inject more money so that we can earn during this period, right? So back to the property market, back to Chris. So what do you see in the future projection? Like, do you think it's a good positive sign, or could you just share with us like more of your insight, please?
Okay, thank you, Maya. So for this part, let me share with you a news that I chanced upon just recently this year regarding the current property market trends. So in fact, in Business Times, even in Straits Times, and also in many newspapers, they projected that prices in property will be on track to double by 2030. And last time when I'm thinking on this, it was like, wow, it's very crazy. And this itself can be seen in the current situation where in the past, currently, our average prices in Singapore, in fact, this is in 2019, May, this is the mid of it, is around 1,005 per square feet. And today, it rose up to almost 1,000, 8,009. And it's projected to go up to by 2030, 2003, and 2009. And that is based on just a population of 6.3 million to 6.5 million. So why is this so? This can actually back up with very, very fundamental, understandable terms in the Singapore market. And this can be seen by firstly, number one, the population white paper. So population white paper is 6.5 to 6.9 million projected in 2030. And this increase in population will lead to an increase in demand for not just daily necessities, but also land, which is scarce in Singapore, hence driving up the demand and hence the price. And this is very simple to understand, but understand motivation behind it. Because some people say, this is ridiculous. Why would it increase so much? Why would they import foreign talent? But understand Singapore, because of our generation, not giving enough babies, okay, what we are having is a situation in 2018. We see Singaporeans with below 15-year-old, the percentage of Singaporeans with below 15 years old, and the percentage of Singaporeans above 65-year-old, it make a cross point and project to increase to 27%, okay, for the older population as compared to the younger population on 10.8% by 2030. This implies an aging population. The only way to solve this issue, this fertility problem, is to import foreign talent. And the key driver for this, you must understand that how related to Singapore property is that foreigners, in fact, common in PR even, they cannot buy BTO. Okay, they cannot buy BTO, and they themselves also cannot buy a resale HDB, okay, unless it's to PR. So this limitation will force them, in fact, to channel most of the resources into the private property sector, hence driving up the demand. And you can see in the later charts I'll show later on how private property market, even with cooling measures, have been continuously rising for the past 10 years. And this itself, you understand even further, okay, most of these individuals who's coming to Singapore, they are not like the blue collar workers, they are actually the white collar workers who have the capacity to afford for this housing, who have the income to enter into this market. In fact, just recently, I chanced upon a lot of foreigners who are coming in from just, 3 months back, in terms of China and Hong Kong and Indonesia, who are pumping their money into Singapore. Because as you can see, the property bubble, as compared to overseas, is considered very low in Singapore. So all this together with this future projection of professionals who reside in Singapore, they themselves will actually push out the private property market. And in fact, if you don't know, I heard a lot of insider stories from some of my business owners. They have been foreigners coming into Singapore, dumping lots amount of money. You heard of famous story like Jackie Chan, Jet Li. They themselves have secretly come to Singapore citizens and putting a lot of cash into Singapore by just buying the Singapore citizenship and to own multiple properties in Singapore. And that itself is another channel that is pushing up the property prices. And the second fundamental analysis we're looking at is just a simple idea of real estate as an inherent asset. Real estate itself will increase in value just simply because of inflation. Just imagine a plot of land together with the service, build the plot of land, to build the building, the materials, all of this are increasing in terms of inflation over a period of time. We project a 3%, and with all this expert real estate is bound to increase just through inflation alone. And you can see, if you look at this graph itself, the midpoint, okay, as project all the way up to the current pricing, which is around here, it has been growing at a constant rate of 5% per annum. And this itself is one of the key things that even with the next low, which will not happen because the bubble won't crash, what we'll see is a constant increase in pricing for 5%. And by this amount, 5 to 7%, it's very likely that the property prices will most likely double. 1,005 to projected almost 2008 and even 3001 for some of the reports by Morgan Stanley Research. And the last thing I want to highlight, in fact, is this thing called the government measures. They themselves is one of the key drivers of Singapore property to allow it to grow in a sustainable way. As you can see currently, in 2013, as explained just now, there were a series of cooling measures which caused the property to fall below that and all the way down while the GDP is increasing. So this itself, you can see, is actually an artificial suppression of the pricing. It's just like, a ping pong ball. When you press it into the water and just holding on to it, and when you release it, what you will see is is a huge spout in the increase. And this itself is one of the key drivers you can see in the next 10 years allow property price to continuously grow in value. And in fact, the government have came in with different measures, in fact, cutting the number of units allowed to build in a condo by increasing the minimum size. And this itself, once again, not only just cut the supply, but at the same time, one of the key driver is that the property, although by the same per square feet, when it's bigger size, the total value of property would be more expensive. A two-bedder that costs 1 million, by the same, because of this ruling, will cost maybe 1.2 million just by this alone. And this will continue to jack up the pricing. And the last thing, which I want to really highlight, this is the key to understand the market in the cold situation I think currently. So in 2018, 2019, what people see, the feeling of oversupply, there is 58,000 of units coming to the market. And when people think of a lot of supply, they think that the prices will fall. And contrary to what people think, the prices did not fall. During COVID-19 situation, you don't see developer giving huge amount of discount. In fact, they're holding their prices and waiting for the market to pick up. This shows how strong the confidence is. And another thing is because of government cooling measures, okay, the developer, okay, they actually plan it nicely such that this 58,000 is spread within the next 5 years. And this is the key because what people see is here, and when people see the oversupply, they have poor sentiment, they don't want to buy, and that's when prices are low. So you enter at this period of time, what you can see in the next 5 years, because there's no en bloc going on, there's no government land still going on, all these prices all these units will get taken up over these 5 years. And if you average out the 5 years of the net supply is 11,367 units. But on the other hand, if you average out the past 10 years of net new take-up is 11,406 units. So it nicely balanced out. And what you see at the end of the day, at 2023, you will end up having, once again, a depletion in the supply. And when supply dropped in 2023, which is just nice 3 years after that, after the seller stamp duty, where you don't have to pay any tax anymore, you can leverage on this drop in demand, and a drop in supply, and by then there will pen up demand and cause it to push up the pricing. And once again, en bloc will happen again to cause another cycle of the property market. So in long term run, what we see is definitely a very strong confidence and increase in 2016 to 2030 of almost double in the value. So yes, this is a basic analysis. I hope it makes sense to you. So back to you.
Hi.
All right. So did everybody swiping your money yet? Are you convinced to purchase a property now? So, all right. So now that we understand more about the property market, right? We would like to find out more about the shares market. So for those who are curious, we are wondering like, is there any free lunches in investing? Back to Jonathan.
Free lunches. Haven't heard that term for a while. Free means you don't have to pay a price for it. It's possible if you go to the library, you get free knowledge from there. But seriously speaking, a free lunch to me would be something, investment product that comes with a guarantee. Well, there are guaranteed products today that are available in the market. I'm sure we have all heard of SIA. We know that they are getting a $15 billion rights issue. Basically, they are raising 15 billion Sing dollars. But did you know that they have already borrowed money and that they have something called an IOU, a bond? A bond is an IOU issued by SIA to a bondholder, an investor, in which SIA promises to pay back the face value. Currently, this bond is selling at 4% discount to the face value. And when you get to 2024 March, you get back the face value of $1 versus 96 cents. And in the process between now to March 2024, you also receive $3.03 per bond. So that would be the closest thing I would say to a free lunch. And the other thing I need to point out is that Temasek Holdings Singapore's sovereign wealth fund controls 55% of the votes in SIA. So you basically have a company that's promising to pay you 4% from your entry plus 3% every year, and is backed by Temasek Holdings, which in turn is backed by the Minister of Finance. So that is what I call a free lunch. But please do not go out to buy immediately. Speak to an investment professional to see if you have the need for it, or if you have already prepared yourself before you plunge into investing. So Maya, back to you.
All right. So thank you both for your sharing. For now, we will be having a 10 minutes break. So meanwhile, if you have any questions, for example, what should I invest on? What kind of shares that we should look on? Any particular questions that you are very curious about in terms of shares or in terms of investment properties, feel free to write them down below on the website below. Questions, write it down, and then we will look through it, we will crunch it, and then we will ask our experts. So meanwhile, we'll see you later at 5:40 and be back right here. See you there. Hi, welcome back. Thank you for staying with us. So for now, we will have the Q&A session. We have a lot of questions coming up. There's so many people who are curious about the market right now. So we'll have the first question directed to Zubin Tan, who is asking Jonathan, are airlines a good investment now? Back to Jonathan.
Airlines, they are never a good investment in any season. Yes, we do travel on them. They have cheap fares, but look at the competitive landscape. The manufacturers sell you aircraft, lease it, whatever you do with it. The airlines do that. But the airlines have to compete against government-owned ones. SIA, Cathay Pacific will go up against Japan Airlines, against Malaysian Airlines, against Royal Thai, against Alitalia. Every one of those national airlines, the Italian, the Japanese, the Malaysian, they are living on subsidies from the government. The private airlines can never beat them. You can look at all the matrices. How much revenue per employee? What's the cost to the revenue? All these are matrices that you can compare across the various airlines. The state-owned ones shouldn't be in business. They are like a zombie companies, airlines. They shouldn't be surviving, but they survive simply because they are eating not the brains of humans, but they are eating the brains of the taxpayers in those countries. So, no, Zubin, airlines are never a good buy at any time. None of the airlines, Qantas, Cathay Pacific, in the Asia Pacific, SIA, they don't even make 5% per annum on the net profit margin. That is abysmally low. So my point again, airlines like F&B sector, you should avoid like the plague. They'll never make you any money. Back to you, Maya.
All right. So we have the second question by Terence, who is asking, are there any industries you might want to avoid due to the length of the time those industries will need to recover from this COVID-19? So assuming that you answer the question about airlines, we should probably avoid the airlines industry. So what other industries that you would recommend that we should totally avoid due to this COVID-19? Back to Jonathan.
Sectors that should be avoided. I have been thinking of sectors that are actually attractive. So let me rephrase it this way. What is everyone using and doing more of that are attractive? I did mention earlier that the streaming services like Zoom or Netflix, whereas Disney, they are still more in the hotels, hospitality, rather than entertainment business. And Disney streaming hasn't started. So neutral on Disney. Sectors that I like are perhaps defense, both here as well as the US. Pharmaceutical companies, they are all racing to develop the next vaccine. So Johnson & Johnson, the 31st March results just came out about a week ago, and I was looking at the results. Two of their three business divisions did very well. The pharmaceuticals, the fast-moving consumer goods did well. The medical devices went down, but overall, Johnson & Johnson actually posted better quarter year-on-year results than Q1 2019. So I would say pharmaceuticals, telecoms, shopping, e-commerce like Alibaba, Amazon. So let's leave not what is unattractive, but let's gravitate to what is actually where the money is flowing into. Like I said from the start, the money has not left the planet. It is just being diverted into specific sectors and specific companies within those sectors. Back to you, Maya.
All right. So, Chinkang, I hope you are taking down notes, right? Those that Jonathan has mentioned are probably the sectors that we should write down the notes and copy down and do our research, right? So next question we have from Boss He. He's asking Jonathan. So like the market had recovered quite a bit recently, and many analysts are saying that this rally will cause much bigger sell down than seen in March. So do you personally think that the market will fall even further?
The overall market, it will probably test the 2208 12-year low that we hit on the 23rd of March. Yes, I believe that there will be some correction. This rally cannot continue because the aggregate demand, the unemployment is rising. So demand is dropping in the economy, not just here. Countries that need our services, that we provide services to, they are also needing less of it. So aggregate demand in the Asia Pacific globally is dropping. So the stock market is a voting machine on future growth of companies. So when you can see the demand dropping, the voting machine will naturally sell down the shares. But again, like I stress, it is a stock picker's market. Every sell down makes money for the exchanges. For those who don't know what exchange is, it's a place where a buyer and a seller comes together. They exchange capital. I sell you what I have, and you pay me what I have to sell. And regardless of whether the economy is doing well or not, the exchanges are doing well. They are called NYSE, New York Stock Exchange, London Stock Exchange, Singapore Exchange, Hong Kong Exchange, Australian Stock Exchange. And the futures market, futures is another type of financial instrument, which I won't go into, but the biggest in the world is sitting in Chicago. It's a CME, Chicago Mercantile Exchange. You can look at how, when you see the Q1 results, they are doing fantastic. And you can find them on the New York Stock Exchange. They're quoted there, CME. So have a look at that. And of course, do your due diligence or consult a professional before you plunge into CME. But there are sectors there are champions in these sectors that you should pick. So index may drop, but the champions will rise. In Singapore, SGX and Sheng Siong have both hit all-time highs. You can see, I told you again, 12-year low, 23rd March this year. Yet, Sheng Siong and SGX are hitting all-time highs. Back to you, Maya.
All right. So we have Sue I believe she is not very familiar with investing. She's actually asking like a tip to which stocks would you recommend on investing in long term wise, and around how much capital will be good to be put in. Also, she's also asking, does it mean that because of COVID situation, most stocks that are investing, example Amazon, Apple, will see a huge increase after maybe 5 years at least? Of course, Sue also asked,
Okay.
what do you recommend would be the best free lunch stock for this current situation? Back to you, Jonathan.
2 questions. First one, my stock picks. Amazon is actually not so much in the business of e-commerce. You must see that the most profitable division is actually Amazon Web Services. That is the cloud service that it competes against Microsoft Azure. So if you look at the financial numbers for the internet giants, you see that the web services, the hosting services, the data centers, that is a sector that's going to do well in good and bad, because we're simply not spending so much time in the malls or in the restaurants. We're actually migrating into data. So if you're looking at 1, 2, 3, 4, 5 years, a data center operator like Capital DC REIT or Mapletree Industrial Trust, listed in Singapore, they have a lot of data centers. But Mapletree is only 30% data centers. 10% of their properties are not in data centers. So please consult a professional on that. So you look at the trends that are definitely going to do well: data centers, data streaming, etc. Now back to your question on Apple and Amazon. Apple is actually selling services and subscriptions, and that is the business to be in. My Microsoft Office 365 is a subscription base, and does it, even though I mean using it more today or even less, I will never stop it, simply because I'm so familiar with it, and it's very difficult for me to shift to another Office suite. So once Microsoft has sunk their hooks into me, I will stay with Microsoft 365 online. So once Amazon Prime, shop on Amazon, and you are stuck into it, you will not leave. Yeah, so I hope I've answered your question, Sue. Back to you, Maya.
All right, so now we have a lot of curious youngsters, all right, who wants to ask Chris about property investment. So to Chris, like, what do you think as a youngster we should invest first? For example, we have BTO, the very cheaper option. We have EC, as well as resale, as well as condominium. So as expert in the industry, what do you suggest we should do to make the best of this investment, and especially during this period of time?
Thank you, Maya. So for this question, what we must look at is in terms of the cash outlay that the youngster have. So for a good start, BTO comes first if you don't have any cash outlay. But if you do have the amount of cash, which can unlock through many different ways, one way that I found out recently for some of my clients who are like this 22, 23 recently, what they did is that their parents actually save up a lot in terms of their CPF after years of employment. And what they have at the age of 55, after setting aside retirement sum, they have almost 500, 600K. They just take out maybe 150K, 200K just to let their children invest, their children have a head start. And this is a very key thing that we look at, because if you look closer, for the past trends, since 2013, HDB have been dropping, and the past 2 years, it has dropped by 3.5%. And the basic understanding of this is very simple, because firstly, for BTO wise, they are actually, as I mentioned just now, they are having lots of influx in BTO. And as compared to the past, where BTO is almost $6,000 for a 5-bedroom, now it's almost 500K. That was $6,000 in a city area. Now it's in a non-mature estate like Tengah, it's going at almost 500K for a 5-bedroom. So the inflation has gone up to 8% to 9% almost every single year. So the amount of profits you can get from BTO now is much less as compared to the past, where last time you can get almost 150 to 200K, now maybe 80K. After taking away the CPA accrued interest is even much less after not 3 years, but 8 years. 3 years to wait for BTO to build, 5 years to wait for MOP. And this is something they noticed in the industry. And it tallies very closely to what the government is pushing for, affordable housing for HDB. That's why they have been suppressing the prices. And in the future, what we'll see is HDB will continue to plateau. BTO have less returns as compared to condo, which within 2 to 3 years, in fact, 3 to 4 years, you can earn almost 150K to 200K just in profit. 3 times the cycle of HDB, which is 8 years. So this is something we have noticed in the industry. And the last question regarding between EC and condo, which one is better? Personal preference. Firstly, it depends once again what's the portfolio. But if you have the cash, the key is to go for condominiums because currently the EC prices have already reached quite close to that of condo. Last time EC prices almost 40% subsidized as compared to condo, but now it's almost 10% below that of the condo market rate. So if you want to gain the most amount of profits, if you can afford EC, definitely you can actually afford a condo, which requires you to have less income as compared to an EC. That's irony, right? Less income. Because EC, with your current income, you can borrow less as compared to that of a condo, which allow you to leverage more. So in terms of capital gain also, for EC you need for 8 years, condo is 3 years. So when you have the amount of capital, start with condo. But if not, definitely for youngsters who are starting out, the key is to start with a BTO at least, rather than HDB resale, where the lease is getting older and there's more influx of HDB in the future. So yes, Maya, back to you.
All right. So now that we know briefly, you keep mentioning about like money, right? And then the question is, how much are you referring to? $100,000? $500,000? I mean, we just want to know like briefly where we are standing in terms of our financial status.
Okay, so for a start for millennials, a good start will be around $215,000. 185 to $215,000 for a start with a good investment property that has value. There are some property that's very cheap, and those some are not that worth to invest in. But if you have at least that amount of capital around $215,000, it's a good way to start up with. And yep, that is for my side. Maya, back to you.
All right. So the very, very last question that we want to ask you is that do you recommend property with high rental yield or property investment?
For the current rates we see, rental yield is going at almost 3% for residential property. For industrial, it can go up to 7%, 8%. But the key thing is that if we are looking, we are younger, okay, it depends once again, depends on how old are you. If you are below 50, maybe 45, thereabouts, or even younger when you're 30, you should focus on short-term flipping. Because short-term flip, every time when you flip 3 years, it's 200, 300K. And currently for CBD property can go up to 700, 800K. In fact, for example, there's a case study in the sale, when back then in the 2008 financial crisis, after it rebounded from 600, 700 per square feet, jump all the way to 3,400 per square feet. And this will see another scenario like this that's happening in the CBD area. That's one example. And that itself, most people earn almost 1.3 to almost 2 million just in profits. And today, the price dropped a bit to almost 2002. And that itself will have it at least a 1 million to 1.2 million gain. And this is what we see in current property market. And back to your question regarding rental yield, you may earn 3% per annum, but if you can get a property, it can give you almost 40% gain in terms of equity per annum, which is 120% gain after 3 years. The answer is very clear in terms of comparing the two. But if you are going towards retirement age, maybe 50 and above, you should work towards more defensive play. We'll look at more passive income from not just simply residential property with high rental gain, which you can do a lot of things to increase high rental. That would be another topic. But at the same time, you can look at industrial property. which can allow you almost 7 to 8% in terms of the return. And the key is there's 20 criteria to actually identify the right investment property, and that itself is further things to talk about. So, yep, Maya, back to you.
All right. So very, very last question for today, because we are short of time. We have Andrew who is asking, okay, let's say I'm so convinced by you, Chris. So how am I supposed to start my property investment journey if I'm very interested and I have the capital to do so?
Okay, so for a start, I need to analyze your current financial standing. And that's why it's good to have one-to-one consult, because every single individual is different. Some individuals, it's more offensive play, some is more defensive play. So for a start, for the first thing that you need to take note for property investment is the outlay in terms of cash or CPF. So cash or CPF, as I said just now, can add up to 220K to invest in at least a decent condo that can make you that 120 to almost 200K in profits at minimally 120K. And that is really assured. Based on just defensive play, means that you're buying undervalued as compared to other people, especially markets now. And another thing you must take note of is in terms of your loan. Because your loan, if you buy a property, understand that a property that costs 1 million, you can only maximum borrow up to 75% of the property value. So 1 million property, maximum loan you get is $750,000. So for the rest, it must be either cash or CPF. So for this entry point, you must understand that your income must be at least around, for 750,000 loan, combined income for household 6,000, 5,830, thereabout, you can get a loan of 750K, which is the key I highlight just now. Because a lot of people think that now housing is getting more and more expensive, but the truth is a lot of people can afford, but they don't know about it. That's number one. And number two is when you see the foreigners coming into this particular Singapore property market and investing, that is when the gap becomes wider and wider. And that itself is, as long as it's pegged to the government of 5% increase per annum, it's a very safe projection that government wants for asset to grow and to increase at this rate. So yeah, that's from me. Maya, back to you.
All right. So we have finally come to the end of this week's Host Now live show. Once again, we would like to thank our guest speakers, Chris and Jonathan, for sparing us some time to be on the show and educating all of us. We would also like to thank our audiences in Singapore as well as overseas, wherever you are. Thank you for joining us today. So coming up next week, we will have a discussion regarding data privacy and the impact it has when working from home with Cartrix Lexman. So before we go, I'm sure you have a lot of questions that you are still unsure about. We will set up a communication line with our guest speakers for you to continue the conversation with them directly after the show. So you'll find this at our website or on the QR code after this segment. And before you go, remember to scan the QR code. Give us your feedback. Tell us how to improve on. If you think that Chris is handsome and Jonathan is dashing, please feel free to do so. So we hope that we've enlightened you in some way or another. Otherwise, same time, same place. We'll see you next week. Bye.